Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into First Merchants Corporation's latest annual report. Forget bedtime stories because this 10K is packed with enough twists and turns to keep you up all night, or at least until the end of this video. This report is a little like a treasure map, hinting at both golden opportunities and potential financial shipwrecks, so stick around. First Merchants, a big regional bank, just dropped their yearly financial health check, a Form 10K filing with the SEC. We are talking about the report that shows how the bank performed in 2024. So let's find out what's really going on behind those polished press releases. First Merchants is a community bank based out of Muncie, Indiana. They have over 100 branches spread across Indiana, Ohio, and Michigan. So before we start, it is important to know that what happens in the Midwest happens with First Merchants. Right off the bat, they lay out the legal safety net, a statement about forward-looking statements. Basically, they're saying, hey, we're going to make some predictions, but don't hold us to them. It's standard, but it's also a reminder that the future is always uncertain, especially in the world of finance. They're telling you this so they don't get sued. Moving on to the business overview, and it seems like First Merchants really wants to be your friendly neighborhood bank, but a bank with a white glove. They talk about their mission to be the most attentive, knowledgeable, and high-performing bank, aiming for exceptional customer service and local decision-making. In this section, they are really selling you on their culture. They also share some interesting details about their employees, or as they call them, colleagues, with 2,120 full-time equivalent employees. They brag about high employee engagement. They even have employee resource groups and education assistance programs. It is all to foster employer of choice status. They perform the employee engagement survey every 2 years. It's not all just for show. Engaged and educated employees is one key to business growth, and this shows a long-term planning. The legal disclaimers continue. They explain how to find their reports online, basically saying, all our official info is on our website, please do not believe random people online. The disclaimers continue later. Digging into their strategy, First Merchants admits they are all about growing their banking business through acquisitions. They are always looking for banks to buy, but they're trying to be disciplined about it, promising a thorough analysis of the impact on both long and short-term financial results. A failed merger can be very painful, and they acknowledge they require regulatory approvals, which are never a sure thing to buy another bank. They have some serious competition in all areas of their operations from many other financial companies. These competitors range in size from national, regional, and internet banks, and even smaller community banks. The report says the financial services industry continues to become even more competitive as a result of changes. Diving into the regulatory world, the report lays out the alphabet soup of agencies that keep them in check: the Federal Reserve, FDIC, CFPB, and more. They mention being subject to capital requirements under something called Basel III, which sounds like it came from a science fiction movie, but is just a set of international banking regulations. The risk section is very interesting because it talks about the industry-wide worries about the failures of Silicon Valley Bank and Signature Bank. Those events could have a material effect on their operations, even if they are unrelated. All these rules dictate how much capital they must hold to cushion against potential losses. They need to hold enough capital or risk limitations and restrictions that include potential dividend limitations. They do mention a regulation called Durbin Amendment. This amendment has resulted in a material reduction of interchange fee income paid by merchants when debit cards are used. This happened because the corporation's assets now exceed $10 billion, and the Durbin Amendment applies at that level. Another hot regulatory topic is the set of requirements that they put in place to comply with anti-money laundering laws and regulations. Of course, failure to comply with these sanctions could have serious legal and reputational consequences. Okay, now for some numbers. They show the corporation's regulatory capital ratios. This includes key metrics like Common Equity Tier 1, Tier 1 capital, and total capital, all compared to minimum requirements. As of December 31, 2024, they say they are well capitalized and above the required Basel III minimum capital ratios. The numbers say that the total risk-based capital to risk-weighted assets is 13.31%, way above the minimum requirement of 10.50%. So at the end of 2024, the report is saying they are in great financial shape. Moving into the financial data itself, the report shows a detailed breakdown of their assets, liabilities, and equity, along with interest rates and differentials. Net interest income is how much they make on the loans and investments minus what they pay on deposits and borrowings. You can see that they earned more in 2024 at 5.69%, but they are also spending more on average to keep the bank afloat at 3.17%. Net interest margin, how profitable their lending is, was down slightly. The net interest spread is the difference between the amount of interest the bank receives and the amount it pays out. The gap decreased when compared to last year. This table is super useful for understanding whether the amount of income is attributed to balance or interest rates. While the change in net interest income decreased almost $25 million, the rate attributed almost $18 million to that decrease. What that means is that the amount of revenue did not change as much as it costs the bank. In this section, we see a breakdown of all the securities. There are both gross unrealized gains, gross unrealized losses, and an approximate fair value. The losses are more meaningful as a result of more unrealized loss, meaning the fair value of the securities went down relative to cost. There was a bit of cost and fair value decreases when comparing 2024 to the previous years as a result of selling securities. The debt securities had $422,000 in gross unrealized gains in 2024 versus losses.